Monetary policy. Monetary policy. Definitions in monetary policy. MSF, bank rate, and MLR. Base rate and MCLR. Reserve requirements, CRR. Standing deposit facility. Open market operations, OMO. Quantitative tools. Demonetization. Implementation, pros and cons. Urjit Patel Committee. Quick revision for shorts notes. 1. Monetary policy definition. Monetary policy. Central bank's use of money supply, credit, and interest rates to influence economic activity, inflation, and growth. Objectives. Price stability, control inflation/deflation, economic growth and employment, financial stability. 2. Monetary policy definitions. Expansionary policy, increase money supply, right pointing arrow, boost growth. Contractionary policy, reduce money supply, right pointing arrow, control inflation. Neutral policy, maintain status quo, right pointing arrow, stable economy. 3. MSF, marginal standing facility. Definition. Lending facility for scheduled commercial banks at penal rate for overnight borrowing from RBI. Purpose. Provide emergency liquidity. Interest rate, usually higher than repo rate. 4. Bank rate and MLR. Bank rate, rate at which RBI lends long-term funds to banks. MLR, minimum lending rate, minimum interest rate charged by banks on loans. Significance, both influence credit cost and liquidity. 5. Base rate and MCLR. Base rate, minimum rate below which banks cannot lend, introduced to replace PLR 2004. MCLR, marginal cost of funds based lending rate, rate linked to marginal cost of funds, ensuring transparent lending rates. Significance, improves transmission of monetary policy. 6. Reserve requirements. Definition, portion of deposits banks must maintain with RBI. Components. CRR, cash reserve ratio, percent of deposits in cash with RBI. SLR, statutory liquidity ratio, percent of deposits in approved government securities. Purpose, control money supply, inflation, and credit flow. 7. CRR, cash reserve ratio. Definition, percent of total deposits banks must keep with RBI in cash. Purpose, liquidity management, inflation control, change in CRR, right pointing arrow, direct impact on lending capacity. 8. Standing deposit facility, SDF. Definition, RBI absorbs liquidity from banks without collateral. Purpose, liquidity management. Significance, complementary to MSF, helps RBI stabilize money markets. 9. Open market operations, OMO. Definition, RBI buys/sells government securities in open market to regulate liquidity and interest rates. Types. Purchase right pointing arrow injects liquidity. Sale right pointing arrow absorbs liquidity. Importance, major tool for monetary policy transmission. 10. Quantitative tools. Purpose, directly influence money supply. Tools, repo rate/reverse repo rate, CRR, SLR. MSF/OMO. Effect, control inflation, liquidity, and credit flow. 11. Demonetization. Definition, withdrawal of old currency notes from circulation. India 2016. 500 rupees and 1,000 rupees notes demonetized. Implementation, announced on the 8th of November 2016, replaced with new currency. Pros, curb black money, reduce fake currency, promote digital payments. Cons, short-term economic slowdown, hardship to daily wage earners, limited impact on long-term black money. 12. Urjit Patel Committee. Purpose, review RBI's monetary policy framework. Key recommendations, adopt flexible inflation targeting, 4% plus or minus 2%. RBI autonomy for monetary policy decisions. Set Monetary Policy Committee, MPC, for rate decisions. Separation of RBI's regulatory and operational roles. Checkmark quick tips for BPSC. MSF versus SDF right pointing arrow. MSF equals lend to banks. SDF equals absorb liquidity. Base rate right pointing arrow. MCLR right pointing arrow repo linked lending for transparency. OMO and CRR are frequent numerical questions. Demonetization questions often focus on pros, cons, and implementation date. Urjit Patel Committee equals MPC plus flexible inflation targeting. MCQ Set 1. Set 1 Monetary Policy MCQs, 30 questions. 1. What is the main objective of monetary policy? A. Control government expenditure. B. Influence economic activity through money supply and credit. C. Manage fiscal deficit. D. Regulate imports. 2. Expansionary monetary policy is primarily used to A. Reduce inflation. B. Increase money supply to boost growth. C. Maintain exchange rate. D. Reduce government debt. 3. Contractionary monetary policy is aimed at A. Stimulating growth. B. Increasing liquidity. C. Controlling inflation. D. Promoting exports. 4. Marginal Standing Facility, MSF, is A. Lending facility to public at subsidized rates. B. Overnight lending facility for banks at penal rate. C. RBI's lending to corporates. D. Loan scheme for SMEs. 5. Which rate is charged under MSF? A. Repo rate. B. Reverse repo rate. C. Penal rate above repo rate. D. Base rate. 6. Bank rate is A. Interest charged by banks to customers. B. Rate at which RBI lends long-term funds to banks. C. Rate for short-term commercial loans. D. Minimum lending rate of banks. 7. Minimum lending rate, MLR, refers to A. Rate at which banks borrow from RBI. B. Minimum interest banks charge on loans. C. Average lending rate of banks. D. Rate set for international lending. 8. Base rate in India was introduced to A. Replace repo rate. B. Replace PLR system for transparent lending. C. Encourage foreign investment. D. Control inflation. 9. MCLR is linked to A. RBI liquidity operations. B. Marginal cost of funds of banks. C. Inflation rate. D. Fiscal deficit. 10. CRR cash reserve ratio is A. Part of deposits banks keep with RBI in cash. B. Reserve in government bonds. C. Bank's capital requirement. D. Minimum lending rate. 11. SDF standing deposit facility is A. Lending to banks at repo rate. B. Absorbing liquidity from banks without collateral. C. Lending to corporates. D. Loans to SMEs. 12. Open market operations, OMO, involve A. Printing money. B. Buying/selling government securities to control liquidity. C. Setting lending rates. D. Regulating imports. 13. Quantitative monetary tools aim to A. Influence tax collection. B. Directly change money supply and credit. C. Control fiscal deficit. D. Regulate exports. 14. Repo rate is the rate at which A. RBI borrows from commercial banks. B. Banks borrow short-term funds from RBI against collateral. C. Banks lend to public. D. Government borrows from RBI. 15. Reverse repo rate is A. Rate RBI charges for loans to banks. B. Rate at which RBI absorbs excess liquidity from banks. C. Rate of lending to corporates. D. Interest rate on government bonds. 16. Demonetization in India, 2016, involved A. Withdrawal of 500 rupees and 1,000 rupees notes. B. Withdrawal of 100 rupees and 200 rupees notes. C. Introduction of 2,000 rupees note only. D. Abolition of old 100 rupees note. 17. The main purpose of 2016 demonetization was A. Control inflation. B. Eliminate black money and fake currency. C. Increase government revenue. D. Promote exports. 18. Which of the following was a positive impact of demonetization? A. Increased cash availability. B. Curb on black money. C. Reduced unemployment. D. Immediate economic growth. 19. Which of the following was a negative impact of demonetization? A. Rise in tax compliance. B. Short-term slowdown in economic activity. C. Boost in digital payments. D. Strengthened banking sector. 20. Urjit Patel Committee recommended A. fixed exchange rate policy. B. Flexible inflation targeting with MPCC. Increase in fiscal deficit target. D. Complete deregulation of banking. 21. Inflation target recommended by Urjit Patel Committee. A. 6% plus or minus 1%. B. 4% plus or minus 2%. C. 2% plus or minus 1%. D. 5% plus or minus 3%. 22. The Monetary Policy Committee, MPC, is responsible for A. Fiscal policy decisions. B. Setting interest rates for inflation targeting. C. Regulating imports. D. Lending to small enterprises. 23. Which of the following is a direct tool of monetary policy? A. Open market operations. B. Government subsidies. C. Tax reforms. D. Public expenditure. 24. MSF is primarily used for A. Regular lending operations. B. Emergency overnight liquidity. C. Investment in public sector projects. D. Funding government expenditure. 25. MCLR was introduced to A. Replace base rate for better policy transmission. B. Control fiscal deficit. C. Fund government projects. D. Replace repo rate. 26. CRR increase by RBI leads to A. More liquidity in banks. B. Less liquidity in banks. C. No change in liquidity. D. Increase in fiscal deficit. 27. Open market purchase by RBI. Absorbs liquidity. B. Injects liquidity. C. Reduces fiscal deficit. D. Controls imports. 28. Quantitative tools include all except A. Repo and reverse repo. B. CRR, SLR adjustments. C. Open market operations. D. Tax rate adjustments. 29. Disadvantage of demonetization included A. Elimination of black money. B. Boost to digital economy. C. Temporary cash crunch affecting informal sector. D. Improved banking deposits. 30. Standing Deposit Facility, SDF, differs from MSF in that A. Both are identical. B. SDF absorbs liquidity without collateral. MSF lends liquidity at penal rate. C. SDF lends to banks. MSF absorbs liquidity. D. Both are only for corporates. Answer key with detailed explanations. Set 1. B. Monetary policy uses money supply, credit, and interest rates to influence economic activity, growth, and inflation. B. Expansionary policy increases money supply to boost growth and employment. C. Contractionary policy reduces money supply to control inflation. B. MSF allows banks to borrow overnight from RBI at penal rate. C. Penal rate above repo rate is charged under MSF. B. Bank rate is long-term lending rate of RBI to commercial banks. B. MLR is the minimum rate banks can charge on loans. B. Base rate replaced PLR to ensure transparency in bank lending. B. MCLR links lending rates to marginal cost of funds for better policy transmission. ACRR is cash reserve requirement with RBI to control liquidity. B. SDF absorbs excess liquidity without collateral from banks. B. OMOs are buying/selling of government securities to adjust liquidity. B. Quantitative tools directly control money supply and credit. B. Repo rate equals short-term lending from RBI to banks against collateral. B. Reverse repo equals RBI absorbs excess liquidity from banks. A. 2016 demonetization withdrew 500 rupees and 1,000 rupees notes. B. AIM. Curb black money, fake currency, and promote digital payments. B. Positive effect. Reduced black money circulation. B. Negative effect. Temporary economic slowdown due to cash crunch. B. Committee recommended flexible inflation targeting. B. Target inflation, 4% plus or minus 2%. B. MPC decides repo rate and other policy rates for inflation control. A. Direct tools include repo/reverse repo, CRR, SLR, OMO. B. MSF is emergency liquidity tool. A. MCLR replaced base rate to improve transmission of policy rate changes. B. Higher CRR reduces liquidity available for lending. B. RBI buying securities injects liquidity into the system. D. Tax rate adjustment is a fiscal tool, not monetary. C. Demonetization caused temporary cash crunch affecting informal sector. B. SDF absorbs liquidity without collateral. MSF lends at penal rate. MCQ Set 2. Set 2 Monetary Policy MCQs, 30 questions. 1. Which of the following is an indirect